right, let me put on voice activity here quick. So I want to talk about a few, we're going to talk about SFPs and trap traders, but I do want to talk about a few things. One that I kind of mentioned earlier. Look, a one-to-one trade is, for the lack of, look, let's not split hairs. It's basically break even on crypto trades, right? Like pretty much on most crypto exchanges, after accounting for trading fees and potential slippage, a one-to-one risk to reward usually ends up being break even, maybe give or take. Now, the trade that I had mentioned here, did you take that trade by chance, Bobby? Did you take any trades today?
I haven't took no trade.
Okay, good. On a normal day, we're looking for a London sweep. We never really got back above it. It did briefly for like 30 seconds. But before that even happened, I wasn't even interested in the trade. And I wasn't interested in the trade because I think at the time, we were like something like this. I mean, it was a one-to-one trade back to VWAP. I'm just not interested in that. I'm not interested in breaking even and wasting my time. Sure, maybe it goes higher, right? But that's trading based off of hope and not trading off of like sound systems. So if you're day trading Bitcoin or anything, if you're day trading anything, you're like intraday trading, scalping, whatever you want to call it, and you're below VWAP, but opposite side liquidity is further away. So that was the case here, where we were below VWAP, opposite side liquidity is the daily high, which is Tokyo and London high. What's the target? What's your target for figuring out risk to reward? Anyone want to take a stab at that?
Well, that's why I didn't take was so close to the trend line.
Yep, 100%. I think that's the right answer. I think.
I figured if it broke that trend.
Yeah, no, that's the right answer. I think we cannot stretch, and this is just like a general lesson. This isn't to anybody, but we don't want to stretch our reward unrealistically. We want to measure RR to VWAP or the next logical structure. Maybe that might be different things for different people. It might be a midpoint, some other reversion point, an order block, a fair value gap, or just opposite side liquidity. We want to avoid overestimating reward potential just because opposite side liquidity exists. Does that make sense? Everybody, does that make sense? Bobby, you're muted again. I'm going to assume yes.
Of course.
Yeah, so VWAP was the target there, right? Now, if VWAP was higher up, if we were closer to like that daily high, maybe it would have been a good trade. Maybe I would have taken that trade and maybe I would have lost, but it talked me out of it. It being a one-to-one trade talked me out of it. So I think, look, VWAP is always your target. If it's so close to where we SFP'd or broke, I'm probably just not going to take it. Now, if we would have like reclaimed it on strength, flipped VWAP, right, and the buyer stepped in, maybe there's a market structure shift up, maybe there's a long there up to the high, but I wasn't interested down here. Now, I might be interested if we come down to this weekly low and sweep it, but now, let's talk about the next thing. The next thing is context, right? We always throw around the word context. Context is important too. Like today is FOMC day. It's a big day in the market. It's a big news day. I think this is the key layer that separates like amateur, I guess the lack of a better word, amateurs from pros, right? Like you can have the cleanest, and this wasn't really a clean SFP, but you can have the cleanest SFP in the world. Textbook wick, perfect reclaim, and still get run over if you ignore context, right? And it doesn't just have to be FOMC. It could be CPI or payroll or something else, or even a Powell mic moment. I mean, we've seen Powell speak and price pumps or nukes, not even during FOMC meetings and other days too. So I think these news events and these big events can rewrite liquidity rules, I guess, in seconds, or liquidity logic, whatever you want to say. Context overrides pattern. Like the SFPs and really anything that we're trading, I mean, you name it, right? They don't exist in a vacuum. It exists inside whatever the context or the market narrative is. On a normal day, a sweep and a reclaim signals intent. On FOMC day, it could just be pre-positioning or liquidity set up before the real move. I got to imagine that smart money right now, big money, is not building positions right before a major event. They're either already positioned or they're going to wait till the dust settles. All they're doing right now is just collecting liquidity from emotional traders who think it's a setup. Now, that might mean your perfect SFP might actually be a liquidity trap before the volatility event, which is obviously today, FOMC. I think volatility can create false structure during major news days, major macro news days. Levels get overrun and reclaimed multiple times. VWAP, session highs, session lows, even previous day levels can become noise on days like today. So I think on days like today, where you have FOMC, CPI, blah, 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 don't treat structure as sacred. Wicks and reclaims and bounces, they lose meaning a little bit until you get that post-news price stability, if that makes sense. I think if you are going to trade on FOMC days or CPI days or any big news day, I think your confirmation signals must be extra strong, not just it wicked and reclaimed, right? Like today, in order for me to take a trade, I want it to be A+. So there might be days where I trade or I grab an SFP or something, break, whatever, and I don't look at CVD. I don't look for divergences. As a matter of fact, oftentimes I'll take an SFP on a normal trading day and there's no divergences supporting it. But today I'd want those divergences. Today I'd want that extra confirmation signal. I'd want my confirmation to be extra strong. I want extra layers in my trading today. Just because I have no idea what's going to happen. You know, the market expects us to cut rates, but I don't know that for sure. And I also don't know how the market's going to digest that information. We've seen times where they've cut rates and dumped it, and times where they've cut rates and pumped it, and then given it back up on both sides of things. So I think the key takeaway when we're talking just context is structure tells you where price can move, right? Context tells you if it's even worth trading. And I think FOMC days and other days too are landmines. Like setups that normally work can break. Your job is not to predict, it's just to survive and observe until that clarity returns. And that's usually post FOMC. That's usually when Powell gets done speaking. Then you'll start to see positions entering, exiting, institutional money start flowing in again. I think anybody can win when it's calm, when like a normal day, right? Like anybody can win. And I think the pros, the real good traders, win because they don't trade when it's chaos. I think discipline is the trade on days like today. Extra confirmation is the move today. I didn't take the short today because we didn't grab nothing. If you took the short today because your system said take the short, I'm happy for you. So this brings me to my next point is, so look, why is it so important to not care if you miss a move? Why is it important to stick to your setup? Why is it important to not chase every single wiggle, right? Why is it important to not be in every move? Like, why is that important? And I think this one's fundamental, but hardest. And it's especially hard too when like everyone in here has different trading styles, different trading systems, different signals they're looking for. I think it's easy to get swept up in the noise. Someone says something and you feel like you're missing out or something. And maybe you do, maybe you don't. I don't know. But I think this is one of the most fundamental. I mean, I asked like 4 questions there. Like, why is it important to not care if you miss a move? Why is it important to stick to your setup? And I think it's a hard lesson too. It's lessons in trading discipline. I think first of all, you cannot catch every move, right? It's impossible. Crypto's 24/7. And the good news is you don't need to catch every move. It's the market's designed to create the illusion of opportunity everywhere. But the truth is you only need a few high probability, high conviction trades to make serious progress. Trying to be in every move is like trying to catch, I don't know, if you're a surfer, it's like trying to catch every wave in the ocean. Like you're going to burn out and drown. The pros are going to wait for setups that match their edge. The rest is just noise. And I think missing a move just means you're following your plan. When you see a move you could have caught, like how many times have you seen something happen? You're like, I could have caught that. I mean, I do it, right? I still do it today. But I think for me, at least, I think that saying that to myself, like, and usually they're moves that don't align with my system too, where it was like, you know, like I'm mostly trading liquidity to liquidity. I'll see like some kind of breakout and I'm like, oh, I saw it there. I just didn't take it. I could have caught it. I think that's just I think that's my ego is what at the end of the day, when I say I could have caught that, not strategy, right? Because my strategy says don't trade those. My strategy, someone else's might say something different, but my strategy says don't trade those. But missing a trade or missing the trade, that wasn't part of my plan is actually my plan, right? Like that's how it's supposed to be. And I think, like, how do you measure discipline in trading? I think it's measured by the trades you don't take at the end of the day. I think every missed trade that doesn't fit your criteria, just look, it reinforces, number one, it's building your discipline, like it's reinforcing your discipline, but it's also reinforcing your edge and protecting your capital. And I think, you know, another question I asked there, why is it important to not chase every wiggle? And I think that's just emotional trading. When you chase moves, you're not trading your plan. We're trading emotion. You enter late, bad locations, random risk, break confidence in your system. And I think it just creates stress, inconsistency, and, you know, all the bad words in trading: FOMO, fear, revenge trading. The more you chase, the less you trust your process. And I think once you lose trust in your process, the market's going to chew you up. I think the obvious answer is sticking to your setups just builds statistical consistency. Your edge only exists when it's repeated. That's it. Each setup you trade has a mathematical expectancy, but that expectancy disappears if you constantly change your conditions. Every time you chase, you're resetting your math. Every time you follow your setup, you're reinforcing that math. And that the consistency is obviously what allows us to compound, not one trade, right? But hundreds of disciplined trades executed the same way over and over and over again. Questions before we get into SFPs? Yeah, well, and trap traders. Cool. So Bobby, do you want to just kind of ask me what you asked last night? Oh, go ahead.
I got a question.
Yep.
So I noticed even off of this this next support line, because I got a long setup, and even on that, it's the risk to reward is still only like 2.19. The way I have it set up, and I got the target being the resistance line above. But if I move my stop loss a little bit closer, the risk to reward goes up. Should I do that or no?
Where does your stop loss go? Like when
1%.
Nope. So yes, but think from a structure standpoint. Your stop loss goes
where your trade is.
Yep.
Not liquidated, but
invalidated.
Yeah, invalidated.
Yeah, so that's the answer. Is your stop loss goes where the trade's invalidated, and that's it. Now, your job with the math and the, you know, taking your position, or sorry, what is it? Your stop dollars, you know, divided by your risk dollars divided by your stop dollars. That's just to make your stop loss 1%. So your stop goes where where it's invalidated. You don't move it up, move it down. It simply goes where it's invalidated. So if we wick down, like right now on my screen, if we wick down, you know, where's that line at? It's like at 112. So we'd have to come down to what, 111, you know, 8, something like that, 8 to 7, $200-$300 away, ideally, right? You want to see it swept, ideally. You want to see people short, right? You want to see everyone who long that resistance enter. You want to give them time to enter. You want to see that exchange and roll back over. So your stop simply goes below that wick if you are entering on a reclaim here, because that is where your trade is invalidated. So if we did that, let's see, let me drop the long position tool on the reclaim. So you're targeting that trend line, which is what, London low? Was that the trend line or was there a different one? Okay. So yeah, it's like a you know, a 2 something to 1, right? So yeah, I mean, it's not a 3 to 1. You know, and here's one of those situations to where, you know, if I moved it up to VWAP, all of a sudden now it's a 3 to 1 trade, but we don't want to do that. We want to be realistic. Like maybe it's not VWAP. Maybe it just comes back up to that London low, which we have now rejected off of since the dump the whole time. We haven't reclaimed it yet. So can you take a 2.5 to 1 trade? You can, right? It's not a terrible trade. I mean, you know, I would say I would probably take it, like if again, within the context of today. So if I had all my signals lining up, if I saw bull divs on OBV, right? If this low that we're putting in now to the sweep shows a bullish divergence and I see us reclaim on strength, I'll probably take that trade, you know, and I'll just eat that 1% loss. Or now here's the other option. Maybe you don't risk 1% on that trade. Maybe you risk 0.5%. So maybe you take your 1% of your account value and just cut it in half. And that's the number you use. Maybe you risk down. Does that make sense? So if 1% of your account is $460 or whatever it is right now, Bobby, cut that number in half. If it's a little bit riskier of a trade. So you can still take it, but just cut your risk in half.
All right, cool.
Okay, cool. So let's talk trap traders then. What is, and I just, like, I wasn't trying to start an argument with Donkey earlier or anything, but I'm trying to teach you guys what a sweep is, right? Like, did we sweep London low? Was Donkey correct? Yes. But we didn't take anything, right? Like I don't remember where it was. Was it up here? I think it was this candle right here. We took it by like $10. Nobody got trapped in that $10, right? So yes, he is correct. We swept it. But when I'm looking to actually execute off of a sweep, I need there to be trap traders. I need there to be people caught off sides, just like in football, right? I need to hear the refs blow that whistle. I need to see people who are caught with their pants down. So how do we see people who are caught with their pants down? So I think there's a couple ways to do it. I asked Brian on Sunday and he got really pissed at me because I asked a question, but I asked him, how far does price need to how far does price need to move for it to be an SFP, right? Is $10 enough? I don't think, for me, it's not. Maybe for somebody else it is, right? But for me, it's not. It's not an SFP unless it goes like $200 or $300. I need to see people wrecked, right? Like nobody got wrecked here. On this was that first sweep, right? It was like, I don't know how, $30, $10, something like that. There wasn't even enough time there for people to react. I need to see, ideally, the next candle. I mean, this wasn't an SFP, but that's what I want to see, right? That kind of wick. I want to see it drop $200 or $300 below the level. I want to see people enter shorts, right? How do I know if people are entering shorts or not? Well, there's a couple ways to do that. You can throw on the Delta candles, which I'm going to do right now. right? Did people enter shorts on that break? Yes, right? The answer is yes. They're offsides. It's heavier. This is delta. So there's significantly more shorts entered on that break south than longs. So if we would have SFP'd here, right, they'd be in trouble. 164, 116, 53, 44. They'd be in trouble. It just wasn't a good trade from a setup standpoint, right? And we didn't really SFP it. Like we didn't, I mean, it poked its head, I believe it poked its head above for a second on a 1 minute chart, if I'm not mistaken. Yeah, for like a quick second, and then came right back in. And then it was just resistance, 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 right? So you want to see, let me go back to my delta candles. So this is what you want to see. You want to see these traders off sides and price go above them and reclaim the level with strength. That's trap traders. Trap traders are traders who are off sides. Everyone who shorted the break got trapped because price came back up above them into, closing back above the previous swing low or the trend line or whatever you have there. And they're all sweating, right? Where does your stop lie? If you're going to trade, think about it like this too. And here's something I told J-Meg the other day. He wanted, I don't remember, J-Meg, your exact question, but it was, where are the traders trapped or something like that. Do you remember that? If you're with us and not working or something?
Yeah. Well, my question was when do you think they start suffering?
Yes, yes. And my response to him was, where would you suffer? Right? So think about it like that. So put yourself in those traders' shoes. So if you hit short where these people hit short, where would you put your stop loss? Well, I'll give you my answer, right? I'm going to put it where the trade's invalidated. So if I think this is a break of structure lower, which is probably why these people shorted here, I'm going to put my stop loss back into structure, just above it a little bit, right? That's one logical spot. What's the next logical spot? Probably above VWAP. So I would be saying to myself, I need price to go there, right? I need it to go a little bit above that level to wreck all these traders. And then where they get really wrecked, probably above VWAP, because there's probably some stop losses above there as well. There's always liquidity at VWAP, right? That's why it's always a target for us. So I think step one of this is to see the trap traders, which we can see here with delta candles. And then two is, where are they wrecked, right? Where do they get wrecked? And just put yourself in those traders' shoes. Where would you put your stop loss? Where would your trade be invalidated if you were these guys? And then we want to see absorption too, right? Like if you have a bunch of negative candles like this and price doesn't move, what's that, right? Absorption. Like if everyone's hitting short and selling and price isn't moving, somebody's absorbing that. Somebody's soaking that up, right? You can see absorption in other ways too. You can see absorption with your indicators, right? Like CVD, for example. I mean, there wasn't absorption here. I mean, it was just down the whole morning on the 5-minute chart. The 15-minute chart was just nuking down, right? I mean, there was no absorption here. There was no, what's absorption on CVD? Anyone want to take a stab at that? What does absorption look like? Divergences, right? That's absorption. That's why we look for divergences. So if you had, like, from this low right here to that low, all right, lower low, you'd want to see basically the opposite of this. You'd want CVD. I mean, this was not divergence. CVD was just doing what price was doing, but you'd want to see a higher low here. So lower low on price, higher low on CVD, and that's absorption. So there's lots of ways you can see trap traders in absorption. I think the moral of the story is you got to look for them, right? And we do that with delta candles. Ideally, you want to see big numbers. You want to see them price come above them, reclaim your level, and then their stop starting to be hit. Understand that, Bobby, or no?
Yeah. So are the trap traders always going to be where the wick is?
Well, not always. Well, I mean, well, yeah. So for our entry signals, yes. I mean, that's what we're looking for, right? We're looking to see people short the break in this case, right? Or long the break if it's a resistance SFP, and then reclaim that level. We're looking for the trap. We're looking for the trap that the whales set. So in this case, yes, but also there might be trap traders as we come up. That's just fuel to go up. So everyone who's shorted, this isn't a great example of it, but there's trap traders in here. If price starts coming up, right, we're just gonna keep getting all their stop losses as we be sucked up to the next liquidity pool. So from an entry standpoint, yes, it's always going to be on the wick. Sometimes you'll see even delta on SFPs though. And you might see trap trader, like this might just be, let's take this wick that we're analyzing, the 164, the 115, the 53, the 44. Let's pretend those were all zero, is just even. Or maybe a little bit of positive, a little bit of negative, a little bit of positive, a little bit of negative, but not heavily short like this. The trap traders might be up here. It might be minus 200, minus 150, minus 350. So if that's the case, I might want to see price go above that if there's no real offsides here. Does that make sense?
Yeah.
Now, usually though, it's like this. More often than not, you see the trap traders. You see the offside traders here, which in this case, they were negative. And I think if we were going to define what an A+ SFP looks like, it's trap traders just like this. This would, I mean, let me delete. I guess I can't do replay on this type of chart. So if this was like a normal trading day and VWAP was above, this would be a good SFP setup. We trap the traders if we closed above, right? It would have been a good SFP setup. So what does an A+ trade look like? It looks like this. Trap traders, price reclaiming, stop losses being taken out, and we get sucked up. You pair that with, you know, if you have divergences, great, that's showing absorption there. And then you can see absorption on delta candles too. You can see a bunch of red, price not moving, and then we go up and we trap those traders. Someone's eating all those shorts. The market's eating all those shorts. I want to be clear too, you know, the $200 or $300 move that I'm looking for, that's Bitcoin specific. It's, you know, obviously it's not $200 or $300 on the NASDAQ. Obviously it's not $200 or $300 on gold. The SFPs there look a little bit different, but Bitcoin's at $112,000. So it's a little bit different. So yeah, I mean, that's what we're looking for. I would say try not to overcomplicate it. Just try to see the offside numbers, try to see price come up above them, reclaim your level, and then we're just entering, and it's just prices wicking them out. And just make sure it's a good trade. Make sure you're not trading a 1-to-1 risk to reward. Even 2-to-1 might be a little sketch. Can you be profitable and still take 2-to-1s? Yep, you can. But really, I want 3-to-1. 3-to-1 or greater, and if it's less than that, if it's like a 2-to-1 or if it's a 2-to-1 to a 3-to-1, then, or just under a 3-to-1, you know, I'm gonna scale down. You know, instead of a 1% risk on the account, maybe it's a 0.5% risk on the account.
Okay, that's cool.
So simply put, trap traders are just offside traders who fell for the trap. And we want to trade with that fuel, right? Why is it fuel? Because we're just going to wick all their stop losses. Boom. You know, everyone who's shorted the way down and shorted the break. That's just fuel, right? When a short closes, it's a long. And that's just fuel to go up.
Yeah, I get that. I get that.
What else? Anyone got any other questions on this? Around anything else? Well,
Oh, that's it. That's it for my questions.
so sometimes price can look like an SFP, right? Like we've seen this before too. I mean, how many times have we seen price like it can wick $300 below, or let's just say above a level, right? And then reclaim it and then go higher, right? We've seen that before a lot of times, though it is an actual SFP. But how do you distinguish that? So let me draw out my example here. So we have, let's just say, whatever level here that you're looking to trade. Price will wick above it, couple $100, come back down into the range. It looks like an SFP, and then it goes. Have you guys seen that before? I mean, I sure have. Doesn't happen as often as real SFPs happen, but fake SFPs, fake liquidity grabs are a thing. And I think this is one of the tougher distinctions to teach, because I think it exposes the difference between understanding structure versus understanding intent. So they both look visually the same, right? So price wicks above your key level, like in my example here on my chart. Say it's a 1 hour swing high, whatever, or whatever it is, daily level. It can be anything, and then it reclaims it, right? But one is exhaustion, right? That's the SFP, and the other is continuation bait. So the difference, I think here, it's not in the candle. It's in the context and confirmation surrounding it. So we've already talked about context, right? A normal trading day with no news and just normal price action versus, for example, today an FOMC day. That's what I mean by context. But context can also mean, how have we been trading for the last week or two? If you're trading on a Tuesday or a Monday, how have the last 4 Mondays looked? You know, build your context based off of what has happened historically. And then what's the confirmation surrounding it? So I think for the real SFP, which is just grabbing liquidity and reclaiming level, right? This happens more often than not, where we just literally wick up, reclaim the level, and dump. Or the inverse of this would be, you know, break down, reclaim the level, and pump. That's the inverse of it, if it's support or resistance, right? So a true swing failure pattern is a liquidity event that results in displacement, right? Meaning the market actually absorbed those stops and then flipped intent. So what do you see on a real SFP? You still see the same thing on a fake SFP, which is aggressive wicks. On a real SFP, you'll see high delta on the sweep candle. So you will see breakout traders getting in. So you flip to the delta candles and you would see positive delta, meaning the longs are offsides here. The longs are outweighing the shorts. You ideally would see CVD and OBV or whatever volume indicator you use divergences, right? Price made a lower low, but volume didn't. Maybe you'll see a momentum shift if you use MACD or RSI or some kind of volume surge or change in the footprint delta. And then it's the follow through, right? Not just a wick, reclaim, install. What do the following 2 and 3 candles do? I think the real SFP, it's not defined by the wick. It's defined by who won after the sweep. And I think the flip of that is the fake SFP. This is where this is like a favorite trick of the market makers. It's like they're double dipping, right? They're literally double dipping on their setups. So it starts like a classic SFP, starts just like what I've drawn here, right? Price wicks up or below a level and reclaims it. Looks just like a normal SFP. Wick below London low, reclaim, traders long the reclaim. Then price stalls under VWAP like we saw today, or prior structure, whatever that structure is. Liquidity dries up, then nukes lower. This is what we saw today. It was a fake SFP of London low. That's exactly what happened. There was no actual shift in delta or OBV. We didn't see buyers step up. We did see people short support, London low, but buyers did not step up. Sellers still controlled the flow. We didn't really reclaim it. On a 1 minute chart, it peeked its head up there like 10, 20, 30 bucks or whatever. You know, on a normal day, normal SFP, a normal level when VWAP's further away than it was today, maybe I would have taken that. But there was low volume. When we peeked our head up for that reclaim, no genuine buying aggression. I showed you CBD. There was no OBV divergences, right? I mean, here's 15-minute OBV. No bullish divergences there. There was none on any chart on CBDs. And it just stalled. It stalled under VWAP. Or it might be stalled under a diagonal. It stalled on a key imbalance. There was no structural follow through. And what is that, right? That's just a back test. That's all that is it was a break and a back test, and we haven't broken it yet. As a matter of fact, holy shit, I haven't been paying attention. We took out the weekly low, right? And we're going further. You know, we're about $400 underneath that weekly low now. So now the question is, where do we go next? Probably the daily. If we keep nuking down like this, maybe there's a little bit of support here that I would look for. Otherwise, it's this daily level down at 110.5. It's a dumpy kind of day, but we're dumping into FOMC. Maybe we get a pump post FOMC, and maybe it's off of one of these levels, right? Maybe it's here, which is Saturday and Sunday, but still there's liquidity there. Or it's that kind of daily support there. Or we go lower, who knows? But now you'd be looking for reclaims, right? You'd be looking for price to reclaim the weekly low. London low. Daily high from yesterday or today, sorry, and overnight. So how to distinguish in real time between I got a little off topic there, just kind of talking myself into the next setup. How do you distinguish in real time between real and fake SFP? Volume delta candles, right? Buyers actually take control post sweep. That's a real SFP. Fake SFP would be sellers are still dominating, which was today. Sellers still dominated the London low break. Then you want to look at reclaim strength. This might mean different things to different people. Maybe it's just a strong 1 minute displacement candle above the low. So back above the London low in this case. Now a fake SFP would be weak, a weak move, no displacement, weak chop. And then there's VWAP behavior, right? Which plays a key role into today's London sweep. Obviously if we're trading from south to north, so from down to up, you want to see VWAP reclaimed. A fake SFP, VWAP would be a rejection zone, which was today's trade, right? We were just so close to that London low on VWAP that the trade wasn't even worth it. And I'm glad a lot of you guys didn't take that. momentum indicator, if you use those like MACD or RSI, if it shows divergence, right? Good. But if it continues down, if momentum continues down, if there's no divergences, it's probably a fake SFP. And then there's just follow through, right? Real SFPs go, fake ones stall underneath resistance or fades back below the low, like today for that London low. So I think if you can't check most of those boxes, you're probably seeing a fake SFP. Like if you don't see the trap traders, if we don't reclaim on strength, if we don't have divergences, whatever. If you can't check at least 3 out of 5 or half of those boxes, it's probably not a real SFP. It sure isn't an A+ setup for an SFP. So not every wick below or above is a reversal. Sometimes it's a setup for just deeper liquidity, like we saw today. It was a setup for deeper liquidity because it was so close to VWAP. A real SFP is when the other side actually takes control. A fake one is just bait to reload positions, which they did today. Most traders get trapped because they're reacting to like the picture, the candle, right? The wick, and not the pressure that's behind it. I think like does the candle matter? Yeah, of course it matters. But I think the intent behind it matters more. If price reclaims the level, but flow doesn't confirm, it's not a reversal. It's just a reload. What else? I mean, that's all I got on SFPs and trap traders, unless there's questions.
No, I'm a little bit more clearer on trap traders now.
I think the biggest thing is just anytime we get an SFP, make sure you're looking, or anytime we get what looks like it could be taking out, one of your levels, just make sure you're on the delta candles. Make sure you're watching, OBV in your case for divergences, and that'll help you kind of spot like what's A+ and what's not. Like, I mean, ideally, you want trap traders, you want price to reclaim the level, you want a divergence. Will I still take SFPs off of a good level if there's no divergence? Yep, I will. If it's a good trade. And if I'm even a little bit, like if I'm checking like 4 out of 5 boxes, I'm going to enter. If I'm checking 3 out of 5 boxes, I might enter, but scale down, right? Instead of 1%, it's 0.5%. Anything less than that, I'm just not taking, because it's probably a fake out, like a fake SFP. Ben, how do you see if a retest is completed? Mitch says. I don't know if I understand the question, but I would say I'm gonna explain what I think the question means, and you tell me if I'm off or on. So like here, let's just say this is an example. Price came up, retested, dumped, right? Came up, retested, dumped. Like, how do you know when it's done? Meaning, when is it going to rebound? Or I guess I don't know that I understand the question. I would say market structure, right? I mean, that's number one. We haven't had a market structure shift all day since that New York dump that Donkey caught, right? We haven't had even a 1 minute, it looks like, shift. For sure not a 5-minute shift. Yeah, I mean, for sure not a 5-minute shift. Been a pretty aggressive dump all day. So you want to see market structure shift, right? I mean, that would be confirmation. Like if you want confirmation on when a retest might be completed, it would be market structure shifting. Or if we're still close to that level, like here, like if we came down, retested, came back down, double bottomed, and then broke back through that retest, it's done, right? We took it out. So now we're shifting higher.
So basically, when we break the trend line that we're retesting.
Yes. Yep. But that's only if we're like close to that level, right? Like now, if you're waiting for us to break this again, you're gonna miss the long wherever it is. Do you know what I mean? Because we're so far away from price. So now we're just waiting. Like like how do we trade this now, right? We're waiting for one of our key levels again to be swept. Like we're sweeping everything now. Let me go to an hour chart. Like I think the next level that I'd be watching, and I don't even love this one, but that might be one, the 111.2, which is Saturday's low. Otherwise, it's this daily support. And why do I say daily support? Well, let me get some of this shit off here. Let me go to my daily chart. So it's this blue line right here. I just see 2 candle closes, a wick, this, 2 candle closes. I mean, it just seems like a key level to me. And then also it's 110.5, right? A nice psychological level, quarter level theory shit. It just, with 2 closes here, support. 2 closes here, resistance. Break up and break down. I think that's an important level. I do have a question mark by it though. So if I do take a trade there, it might not be a full 1% on the account. And then daily support below, where we just had 2 daily candle closes. This was the impulse up. So to tie this back to what I was just talking about with market structure, and when you're close to the break, once you get far from the break, your plan just resets, right? Where are we going to sweep? Dailies, weeklies, trend lines. That's what you're looking for again. And then I would be careful. We don't want to catch falling knives, right? We don't want to just start firing off a bunch of aimless longs here. So I think this is where confirmation comes in. So if you're starting to look at levels that are further away from where we started the day like this, like look for 1 hour divergences, right? Look for 1 hour, 30-minute divergences. So if we come down to this low here and here, there's no bull div there. Is there? Oh, I guess here, it'd be here. I guess it's an even divergence. That's not even really a thing because it wouldn't be a divergence, but it's even. Well, you're just looking for more confirmation once we start dumps, just so you're not like catching knives. I hope that answers your question, Mitch. When you're close to that level, you break back above it. That was retested, and that's invalidated. Otherwise, you're back to the drawing board here, looking for longs again, or shorts, right? Like maybe we just pull back to that weekly low we lost, and that's a retest for lower. Let me see if I had anything else for you today, Bobby.
I remember you wanted me to leave all them lines on there.
Oh, yeah. Share your screen. This is going to be a good one, too. And actually, this is partially what the podcast that me and Dunk and hopefully Brian are going to do today.
I got to add the lines back in. just freaking deleted all of them.
Hit the redo button. Or the undo, I mean.
Where's that at?
Right there. So I had someone else ask me, I think yesterday or Monday, like, at what point does your chart become a meme? You know, we've all seen the memes of charts that have like a million indicators on it and a million lines on it, right? Where's the balance between that, a meme chart where there's a million lines on there, and actual tradable shit, right? We make fun of Crypto Face a lot because of his spider lines. He's got a million lines on his chart. It's like, well, of course one of them's gonna hit, right? You got a million lines in your chart, of course one of them's gonna hit. So I think we need to strike a balance here, and I think here's what matters from a price standpoint, right? It's to see where price is reacting and where it's headed next, where liquidity sits. That's it. We're not predicting. We're not here to predict the market. Are we going to go up? We're going to go down. We're only here to react to it. And TA works because why? Why does TA work? It's all human behavior. It's all psychology. It's all self-fulfilling prophecies. The more eyes on something, the stronger the reaction. Whatever kind of trader you are, you're using trend lines, right? You're using everything, every strategy, every indicator is based off of swings, even divergences, right? It's based off of swing highs, swing lows. The more eyes on something, the stronger the reaction is. Everybody uses structure. This is why structure is the strongest, because no matter what strategy you use, you're using structure, whether you know it or not, because it's built into all your indicators, all your indicators, both on the chart on price action and indicators that are down below, right? Like your momentum and volume indicators. So then the question becomes, what matters? What levels actually matter? And I think very simply put, and I'm going to link this into the channel in Discord here, and then I'm going to pull it up on my screen. I think to get like a solid foundation down on what matters, let me get it in the channel here in Discord. I think it's these, man, because this is what everyone's watching. I think it's the weeklies, your macro bias, right? You're looking for major diagonals, trend lines off of the extremes, the wicks and the bodies. So I'm going to show you my weekly chart. So let me get rid of all my other stuff. Five levels, right? Now the weekly low is pushing lower, so you know, I'll adjust that. But this morning it was here. That's where the weekly low is. We've taken out the weekly low now. 5 levels. All I have is the all-time high, because we're by it, right? Now if we were way down at 60K, I wouldn't care about the all-time high, but I do now because it's a strong level. And then I have the current week high, the current week low, last week's high, and last week's low. So why do I mark out the current week open and close? Because it gives bias for structure shifts as well as targets for liquidity and expansion. So when you have a candle, and it can be any candle, right? So here's the wick, here's the body, here's the candle. I mean the wick on the lower side. This is a target for expansion. This is a target for liquidity, whether it's a daily candle, a 1-minute candle, or in our case here, a weekly candle. So there's liquidity above here on the week. There's liquidity here on the week. They're targets. And then it also gives us expansion and is contraction the right word? So if we take out the weekly, we're going to go up. If we lose the weekly, like we're losing now, we're going to go down. But it also gives us reclaim targets, right? Reclaim it, reclaim it. So weekly gives us a snapshot of the current week we're trading. And then when you do the previous week open and close, those are also liquidity and expansion targets. So last week's high, last week's low. And then it's just major highs and lows and trends if they exist, and they don't always exist. The only trend that really exists right now on Bitcoin is this big diagonal. Oops, let me go back to the weekly that I see locally anyways, right? You know, could I do something like this? Sure. I don't love it, but I like this. We're in an uptrend. If we were in a downtrend, I'd try to grab it from the highs, right? Like here, like back in the bear market, something like that. You know, we break it and we're going up, right? If we break this, maybe the uptrend's over and we're coming down. So my weekly chart has 5 levels: the highs, the lows of the weekly, and any other swings, but there's really no swings. And I don't care. I don't need to get into all of this. We're not there, right? If we get there, then I'll start marking them out. But we're not there. So that's weekly. Simple. Keep it super, super simple, right? Let me go back to my cheat sheet here. These are the walls of the market. Macro liquidity zones. Institutions are positioned here. Everything smaller just reacts to these. Everything smaller just reacts to weekly liquidity, daily and intraday. And it gives us directional bias, right? Like we can look at a weekly chart and see what we're doing. We are going up until we're not. And then daily, guess what? The same shit. Previous day's high and low. Major daily swings, high and lows. What do I mean by major swings, right? What's a major swing on a daily chart? It's the swings. It's not every tiny little blip. It's, and in this case, it lines up with the weekly. There's the weekly and the daily highs, right? There's the weekly and the daily lows, this trend line here. There's the daily high. That's it. If we start losing last week's low, which we're far away from that now, you know, we're about $5,000 away from it, then I can come down here and look at these lows, but they don't matter right now just because we're not there. But if they become of importance, if we drop 10%, then I'll start marking those levels out. So it's the same. It's just the major swing points in the market where buyers became exhausted and sellers took over, or where sellers became exhausted and buyers took over. So my weekly chart and my daily chart for Bitcoin right now look the same. They're the same. I don't have to add any daily levels right now to my chart unless today adds a new daily level. But right now, I don't have to add anything. It's just the same 5 levels. These are my main levels that I'm looking to trade. And then guess what? On the hourly chart, it's the same thing. Major swing highs, major swing lows that make sense. When you got a bunch of clustering like you do here, right? There's a low, there's a low, there's a low. Just gets fucking noisy. Like I need to find something stronger. Like I'm not just reacting to 3 levels, like 1096, 1092, 1086. That's shit that's all middle of the range, right? I'm not interested in that. I'm not. It's just noise. I'm not interested when you got a big cluster like this. So I'll go back to the daily when I see something like that and try to make it make more sense. And that's where I found these 2 levels, right? Which is 2 closes, a breakdown, a retest 2 closes, and a break up. That seems strong. And then this right here, where buyers stepped or sellers became exhausted and buyers stepped in. So I just added 2 more levels and that's it. And that's it. You don't need 5-minute and 15-minute levels unless they're liquidity levels. Well, sorry, unless they're session levels. Tokyo, London. I think this is where most people screw up, is trading the 5 and the 15-minute chart as opposed to trading the hour or the daily chart and executing on the 5 and 15-minute, if that makes sense. But that's it. That's it. Those are the levels that matter. And then if you want, throw on your anchored VWAPs, your whatever else you use. But these are just for all this is confluence to the levels you have on your chart. Like I'm not, maybe someone out there has a system where they are going to not blindly, but trade anchored VWAPs. I'm not. I'm looking for anchored VWAPs to line up with my levels to make them stronger. Like right now, that daily support I marked out, I didn't even know this until now, right? Is the value area low. Pretty strong level. The last week's low lines up with an anchored VWAP I have. Just makes it stronger. Also, I mean, this is pretty strong too. Last week's low, you have obviously a low, you have anchored VWAP, and you have the diagonal there.
Yeah, you got good confirmation right there.
Mm-hmm. It's just one of those things. Like I could throw fibs on too, right? Like, do I trade fibs? No. But do people trade fibs? Yes. I don't even have it on here. It's how much I never use it. I don't even know where it is. Where's the fib tool? Right here. So if you wanted to go from like this low, I'm not going to draw them perfectly here, to this high, look at that. Look where the golden pocket is. Or close. I didn't draw it perfectly. You know what I mean? I'm just doing this, but it's pretty dang close to all this shit. So now I know that fib traders are looking around this area. Daily support is around this area. Anchor VWAP's around this area. The 0.5, I mean, maybe if I draw this better. Let's go there. And I've got pretty close to the low there. Yeah, so I mean, there's confluence in this. There's a ton of shit here, right? It's a big range, but there's a lot of eyes are going to be in that range, which is also last week's low. Well, daily support in last week's low. And then value area low, daily support, anchored VWAP. But anyways, all the tools are just I think, right? And feel free to debate me on this. Doesn't mean I'm right just because I have an opinion on something. I think they're just to add confluence to support and resistance, because support and resistance is what everyone's looking at. Not everyone's looking at fibs. Not everyone's looking at anchored VWAPs. Not everyone's looking at FRVPs. Not everyone's looking at naked points of control, but everyone's looking at trend lines. So if you can get all that other shit to line up with your trend lines, it's just stronger levels.